Seeking Yields plus 20% OXLC. This article was written by Rita Morwa. Summary: 2024 saw this fund effortlessly match the overall market for returns. I collected massive income while betting on America. You can enjoy the golden age of America without sacrificing your income stream. I am Rita Morwa. I have been advising individual and institutional clients on high-yield investment strategies since 1991. I lead the investing group High Dividend Opportunities, co-authored by Treading Softly. In 2024, I stated that I was betting on America. The reason being, when I wrote that article on January 14th of 2024, was that historically, in an election year, the economy performs very well. To make that bet on the U.S. economy, I decided against going with just a general market-wide passive ETF, SPY. While many investors do enjoy blindly investing in the general market itself as a way to be exposed to the economy, I wanted something a little more granular. As an income investor who focuses on immediate income, I wanted an investment that would provide me with the majority of returns through cash arriving into my brokerage account. It wasn't surprising that many thought that this was a foolhardy approach and that I would vastly underperform the overall market. What they didn't understand was that the investment choice I was making was one that was closely tied to the expectations of the U.S. economy itself. When we look back on the performance through 2024, we can see that my investment was neck and neck with the overall market and yet provided me with way more income into my pocket than if I had invested in the market by itself. Today, I want to take a look at how the fund closed out the year according to its earnings. I also want to reiterate that I am still betting on America. I expect that this year will be another year where we can have strong economic performance. Let's dive in. They're buying hand over fist. Oxford Lane Capital OXLC, yielding 21%, is a closed-end fund, CEF, that invests in collateralized loan obligations. CLOs are often confused for collateralized debt obligations, or CDOs, that helped cause the Great Financial Crisis. Unlike their red-headed stepsister, CLOs actually provided strong double-digit returns during that same time to investors who were wise enough to hold them without selling. However, the CLOs that you can buy today are not anything like the ones that were available back in the early 2000s or before that. The government has provided various layers of additional regulation due to the failure of CDOs, which is a consequence of their naming similarities. CLOs are considered a leverage bet on the United States economy. This is largely because a CLO is comprised of many senior loans provided to middle-market companies within the United States. Names like American Airlines, Taurus, Dell, and others have all had their senior debt wrapped up in a CLO package and owned at various times by OXLC or its peers. What OXLC does is that they add additional leverage of their own. This makes a CLO fund like OXLC zeroed in on the U.S. economy. If you think the economy is going to do well, then this would be a fund you'd be interested in holding. However, if you think the economy is going to do poorly, then this is a fund you'd want to avoid. OXLC reported another solid quarter, Q3 2025 of its fiscal year. Net asset value ticked up a little bit, but remains about even with where it was a year ago. Core net investment income came in at $0.28 and continues to cover the distribution. Source: OXLC announced its distribution will remain unchanged through June, announcing monthly dividends of $209 per share for April through June. OXLC continued to grow its portfolio with net investments of $355 million. Some might note that OXLC's core NI number has been declining and is getting closer to the dividend. However, it is important to note that there is a time lag between when OXLC makes an investment in a new CLO and when that CLO starts paying cash. Since OXLC has been growing so rapidly, currently $509 million of its CLO investments have not yet made their first distribution. As those CLOs start paying, OXLC's core NII will rise. Meanwhile, the dilution from issuing new equity occurs immediately. In 2022, this is the metric we used to predict that OXLC would start raising its distribution. This time around, we think that a distribution raise is unlikely. We expect that as the new CLOs start paying, OXLC will likely opt to retain capital unless it is required to distribute for tax purposes. So we expect that core NII will go back up. and there will be a larger cushion between the core NII and the distribution. OXLC earned its 20% plus yield over the past 12 months, and there is no sign that will change soon. Looking forward, we expect core NII will drift up as the new CLO positions start paying. As always, the largest risk for CLO equity positions is the default rate, which has remained much lower than most have been expecting. Eventually, defaults will rise, but we expect that this cycle will be quite mild for corporate credit. In the event that we do see defaults rising, OXLC is well positioned to absorb it with very low leverage levels, with leverage including preferred at only 0.28x. Combine this with a core NII we expect will be rising to provide a cushion between cash flow and the distribution. OXLC could absorb a reasonable increase in defaults without having to cut the distribution. It is simply much stronger than it was before the COVID panic, and the cash flow from it is immense. Conclusion: OXLC continues to be a conundrum for growth investors. I often see commenters on our articles espousing negative viewpoints. They look at the fee structure, and they feel that it's not effective or competitive. They look at historical performance and slap a no-go on it without studying the history of what was going on within the U.S. economy or within the operation of the fund itself. This is one reason why income investors can continually find opportunities within the market to get great yields that are fully covered. You see, if an investment confuses investors and they're not able to understand it, they avoid it, thus creating discounted prices and persistently high yields at times. CLOs have long been something that has confused and scared the average individual. They scared the government because of their close naming convention to something that was dangerous and mismanaged. The educated and intelligent investor who understands how income investing works can leverage a fund like OXLC to great results as far as their income is concerned. I don't believe anyone should invest 100% of their holdings within any single company or fund, whether that's the SPY, OXLC, or anything else. This is one reason why I recommend holding no less than 42 different unique investments within your portfolio. Our rule of 42 within high dividend opportunities. A little bit of OXLC can go a long way in providing a massive boost to your overall portfolio's income stream. And as we saw last year, you're not giving up much of anything. That's the beauty of my income method. That's the beauty of income investing. This article was written by Rita Morwa.